Webinar is being sponsored by the Municipal Electric and Gas Alliance, a 26-year-old local development corp that provides electricity and natural gas supply to more than 230 local governments and schools across the state. MEGA also provides consultation and support to its members considering renewable energy projects. Before we begin and introduce our panelists today, we have a few housekeeping announcements. Jeanette Stanziano is our Director of Training and Education. Jeanette. What Jeanette is going to say is that we are recording this webinar and it will be available either this afternoon or tomorrow morning for your review or to send to colleagues. And in terms of question and answers, please submit your questions in the questions panel of your GoToWebinar dashboard. Should be on the right hand of your screen. It's on the right hand of my screen. And so as you get questions throughout the presentation, please type those into that questions panel. And when the presentation is over, I will read those and ask our panelists to respond accordingly. We highly encourage you to ask any questions that come up along the way. Our speakers today are Ying King. Ying is a specialist in the accounting methods and credits and incentives at KPMG. Her expertise includes federal and state tax credits and incentives, including the R&D credit, energy or IRA credits, and various accounting method matters. Ying has advised U.S. multinational and domestic companies ranging from mid-size to Fortune 100 in a wide variety of industries, including technology, software, life science and pharmaceuticals, banking and insurance, manufacturing, food and beverage, and of course, government. Catherine Brakes is the Managing Director in KPMG's Tax Credit and Energy Advisory Services practice, where she advises companies on federal tax incentives. She also advises companies on the impact of federal tax legislation and associated guidance. She has advised dozens of companies on energy tax credits. Catherine assists companies in developing tax-efficient investment structures, including advising on transactions involving the so-called flip structure and inverted lease, performing due diligence reviews, providing risk assessments, preparing tax opinions, reviewing financial models, and providing general federal tax income advice. Marilyn Farley is a tax managing director and leader of the development and exempt organizations practice in New England, upstate New York regions. She is also the national higher education sector leader for KPMG. She has more than 25 years experience in public accounting and has been with KPMG for 15 years. Marilyn has many tax exempt clients, both in the healthcare and higher education sectors. She primarily assists these clients with transactions and tax issues that arise in their operations, such as qualification for tax exempt status, computation of unrelated business income, and analysis of alternative investments, review of compensation and benefit arrangements, and state and local tax filing obligations. She has assisted her clients with the implementation of the provisions of the Tax Cuts and Jobs Act of 2017. Thank you, KPMG team, for being with us today and to lending your expertise to our members.
All right, thanks for the introduction, Mark. Are we good to go? I'm going to see the window with the slide. We're gonna be presenting, so just let me know if we're good to go, and I'll kick it off.
Okay, you can get started, and I will get Jeanette to load the slides ASAP.
Thank you. All right, good afternoon, everyone. Really appreciate the opportunity to speaking with you all and introducing the Inflation Reduction Act, IRA, that was enacted back in 2022. So here at KPMG, we are really seeing organizations across the board, corporations, not-for-profit organizations, and government entities, of course, really putting the sustainability and implementing the renewable energy technologies as one of their focus initiative. And this bill, the IRA, really provided the tax incentives to allow these organizations, especially the tax-exempt organizations, to benefit from it by helping offset their investment were spent through these various tax credits and incentives. And the type of incentives offered in this act, provided in this bill, are quite extensive. And our goal for this webinar session today is to really touch on a fairly broader range of topics that are especially relevant to our government entities, so that you can start thinking about how the counties can benefit from the incentive. What you need to start thinking about in planning out your your investment, your projects. And we're more than happy to answer any questions or take a deeper dive in any particular area that you might be interested in. So as we're waiting for the slide to be loaded up, really the reason we're having this discussion now is because because of the IRA, the Inflation Reduction Act provisions, now the benefits are made available to our tax-exempt organizations, right? Because when we talk about tax credit in the past, there's almost no way for our tax-exempt organizations to take advantage of that, because most likely the credits that were available in the past can only be utilized to offset your tax liability, right? So as an exempt organization, we do not owe any tax. So really the ability for the organization to be able to utilize the credit, again, prior to IRA, was extremely limited. But now the provision, changed everything, right? So even though you do not owe any tax under this IRA legislation, you are eligible to receive a refund from the government through a election that you can make on your return. Well, you may be asking, well, I don't file tax returns, so how am I able to even take advantage of the benefit, which we'll be covering over the next couple of slides. But I guess first and foremost, the most important provisions that we wanted to highlight here is that the tax-exempt organizations, including government entities, can now utilize the benefit of the tax credit by receiving a refund through a direct pay election you can make. Okay. In addition, new credits are also introduced in this bill, such as the credit for the qualified commercial vehicle, clean vehicle, electric compact cars, electric buses. You will be able to receive a credit for purchasing and placing service those EV properties. And the bill also modified the way how the credit is determined, right? And introduced a couple new concepts. The prevailing wage and apprenticeship, for example. Well, that is not a new concept to the world, right? So some other areas of the tax benefit, the concept had been introduced previously, but for the the energy credits specifically, some of the new concepts were introduced in order to determine what the credit rate your project may be eligible for. So now, instead of having a set number or set a percentage being the credit rate for your project, now is in the tiered structure, right? So the more requirements your project meet, the more boxes we check, the higher the credit rate is going to be. So, very interesting concept introduced in the Inflation Reduction Act, which we're going to walk through in the session today.
Thank you everybody for your patience. We had a little trouble getting the slideshow up. It is now up. Ying, this is your first slide. Please let us know where you want to start.
Sure. Yeah. So I just, basically highlighted some of the key provisions we wanted to bring your attention to, such as, the credits now is being refundable. So even for entities that do not typically owe a tax liability, you can make an election in order to receive a cash refund for the eligible credit. And also, we're going to be walking through some of the credits that are going to be particularly relevant and applicable to our tax-exempt organizations, just based on what we see, just by working with our clients in the non-for-profit space. Yeah, so I think that's the highlight of the first slide. Catherine, anything else you wanted to add in here?
I think that's good.
Okay. All right. So we're going to get into a little bit more details about, how exactly you can receive the credit, the eligible credit as a refund, right? So we mentioned there's election you can make on the tax form, which is called a direct pay election. So this is really the vehicle for the tax-exempt organizations, the government entities, of course, that does not owe a tax liability to benefit from this incentive. And the election, direct pay election, is available to be made for taxable years after 2022. So, really, when you think about, all of your, properties you place in service that could be eligible for the various credits, really the window that you wanted to consider is after 1/1/2023. So the direct pay election must be made on a original timely filed return. So as we said, well, what does that mean if I think we can advance to the next slide, please, Jeanette. Yeah, so applicable entities, so we talk about, the exempt organizations, governments, their political subdivisions are all eligible for this refund election. Next slide, please. All right. Yeah, so as we mentioned earlier, right, one of the questions you may be asking is that, well, we don't really file a tax return, right? So what does that mean? The election has to be made on the tax return. Well, so there is a specific form that can be used as a vehicle for you to make the election to claim the refund, which is called a Form 990T. So, once you identify the property that are eligible for the credit, and you determine the credit that your property is eligible for, you just claim the credit on the Form 990T and attach the Form 3800, provide the information. So that would be the vehicle to claim the credit. In terms of the timing, right, for you to keep in mind, the 990T needs to be filed. There's extension available, right? So there's the original date where the tax form is due, and you can receive a extension. So typically is 4.5 months after the end of the year is the original due date, and you can have a automatic extension to file the return, to file the form. So just like talking about some specific dates, right? Just for us to kind of conceptualize the requirements here. So our typical, again, this may not be very applicable to our government entities, but for our typical non-for-profit organizations, their fiscal year typically ends on the end of June, right? June 30th, 2024. So then the original return will be due in November 15th of the current year, of the same year. And with extension, the return will needs to be filed by May 15th of the following year. So that would be the latest that you have to get the forms in to file the return. So if you need to claim the credit for the properties placed in service in that particular year, those are the key days that you may want to keep in mind. So now, for the entities that does not file a tax return, right? We don't have a taxable year already established. You may be able to choose a taxable year that is different from your fiscal year, right? So, we can talk a little bit more about like how exactly that's going to work. But some things for you to consider is that, well, I may need to do some review, do some analysis, looking at the time that you place the properties, the eligible properties in place in service, and think about, well, what is the period that was gonna make sense for me to select to be my taxable year, just based on the timing when you put the place the properties in service. So and in order for you to make the election on the form 990T, right, there's a process you have to go through. So the government really, put a better control in place to, prevent duplication of the claim of the credit, to prevent, fraud, improper payments, and so on and so forth. So that process is called pre-filing registration. So in order for you to, just check the election box on the form, on the tax form, right, you need to supply certain information in that pre-filing registration. So the outcome of that process is that you're going to receive a registration number from the government after supplying all the information about the eligible property you're going to claim the credits for. So you're gonna, put the registration number, provide the registration number on the tax return you're gonna file along with the election, the direct pay election you're gonna make to receive the cash refund at the end of the day. So this pre-filing registration is very important, and a process you have to complete before you can claim the credit on the return. So the current guidance in terms of the timing, right? We talked about, some of the key days for you to keep in mind. And there's a timing to consider for the pre-filing process as well. So the current guidance, if you look at the guidance provided by the government, by the IRS, they recommend that the pre-filing registration be submitted 120 days before you have to file the tax return. So based on what we see and our experience, working with the pre-filing registration process, it probably is not going to take that long for the government to process the information to issue the registration number. But the 120 days is what provided in the guidance, and to the extent that you can submit the pre-filing registration 120 days before the return filing, that would be the most ideal. And obviously, just because the government put the control in place, right? There will be a penalty assessed, potentially a penalty assessed if the payment is deemed exceeding the credit amount that you are eligible for. So just know that there could be up to 20% of the penalty assessed if the claim is deemed improper. Catherine, any additional comments on that part?
Yeah, sounds good.
Okay, all right. So moving on to the specific credits that we wanted to talk through, right? So as you can see, right, on this list, the type of incentives made available in the IRA, it's overwhelming, but it's good. But we just wanted to highlight really the credits that you would typically see in your world, right? The counties, for example, if you install the charging station for the electric vehicles, then there's a credit available for that. if you have a geothermal projects, for example, that is, taking place, for you to take advantage of the earth temperature in order to cool or heat your buildings, then there's a credit available for that technology. If you install a solar panel on the building to generate electricity, then the Section 48 energy credit is also available for that technology, right? So we just wanted to kind of really narrow down the scope of our discussion. I really think about the type of benefit that we see in the non-for-profit, the tax-exempt world, right? Production, some of the production-based credits probably are not going to be relevant, so we're not going to be talking about those. But again, if you have any questions as we go through the content here, just please send me the questions and we'll make sure to address them in the end. So these are the credits that existed prior to the IRA, but significantly enhanced. And what you will see on the next slide are some of the brand new credits introduced in the bill. So I mentioned earlier the credits available for the electric vehicles, right? Section 45W. Also Section 48E, that is the credit, kind of a very new credit that is technology neutral. So if you remember at the beginning of the presentation, I mentioned some specific technologies, right? Geothermal, solar, that were added into the legislation. But starting in 2025, really, the technology is not going to be as relevant, right? So we're going to get into the details of each of the credit, but just know that prior to 2025, your technology has to be one of the 16 specifically outlined technologies in order for the property to be eligible for the credit. And after 2025, the technology is going to be phasing out. So the determination of the eligibility is going to be based on emission level. So, whether that is a solar, whether that is a geothermal property, is not going to matter. What is going to matter is that whether we're having a zero emission facility in place. So with that, Catherine, I think I'm gonna transition over to you to talk about the details about each of the credits.
Yeah, sure, thank you. So I think, as Ying has very well set forth, it's true that localities don't file tax returns and they don't pay tax, but the mechanism for the Inflation Reduction Act provides that localities can file what I'll call a pro forma tax return and claim a credit on that return and receive a refund back. And so I think the thing to keep in mind is that the pipeline of how you get your money is the IRS. It's not other branches of the government. It's not other agencies. It's the IRS. So you will need a tax identification number. You will need to register in the portal, as you mentioned. You'll need to kind of be in the system as far as the IRS is concerned. And by doing that, then you can claim that credit on a return. And since you don't owe any tax, you will get a cash check back for 100% of the credit that you have requested. But one of the prices of using the IRS system is that it has to be on a timely filed return. So again, you need to figure out what is my tax year and what is the extended due date of my return for any applicable year. And I am not eligible for a credit. I lose out entirely, in fact, if I do not have a registration number in hand by the extended due date of my return. There is no appeal. There is no possibility. It's just, you just lost a lot of money because you didn't make the deadline. So it's very, very important to be aware as we talk about these investments, what calendar year it's located in, and then we can talk later about what your tax year is. We are not interested in anything that was finished before January 1 of 2023. Say, oh, you know, place in service a charging station in December 30th of 2022. Not relevant for these purposes. You can just forget about that. So we're only talking about the earliest date is something that finished on or after January 1 of 2023. And then anything you have going forward for the next 10 years, because this is a 10-year bill. Okay, so anything you have in the pipeline that you're going to finish between now and 2034 and 2035, it's all good. Okay, so just keep that in mind in terms of your time horizon. Okay, so with that, let's talk a little bit about what kinds of investments are eligible for these incentives. So if you could go to the next slide. So we've been talking with a lot of political subdivisions and with nonprofit colleges and universities. I've spoken to the National Association of Counties, talking with them about these benefits. And so we've sort of distilled down the discussion based on the things that we think it's most likely you might be investing in that would be most relevant to you. So we're not talking about capturing and sequestering CO2, and we're not talking about wind energy credit. We're trying to get to the things we think are most relevant for this group. So I'm going to talk a little bit about the investment tax credit and what kinds of technologies you might be investing in that would be relevant. So an investment tax credit, just as the name implies, is based on the construction cost. So if you are building something that qualifies for a credit, you take the construction cost, you multiply it by the ITC percentage, and that gives you your credit amount. Okay. So the first thing to figure out is, well, what's my eligible basis? What's my eligible capital expenditures? And there are a whole set of rules that tell you how to do that. And it's a cost segregation analysis, and you would be hiring a third party to help you understand what that eligible basis is, not only for your own forecasting purposes, but also because when you put this on a tax return, you are subject to audit, underpayment, interest, and penalties, as Ying ran through. So you need to have a third party substantiate your eligible expenditures. Eligible expenditures include both direct and indirect costs. So this is going to include your soft costs, costs associated with obtaining permits, engineering costs, intangible costs of various kinds. These are all capitalized into your project. And then you figure out what is my ITC percentage. The base rate is 6%. Then if you enter into a contract for contractors and subcontractors to pay prevailing wages and meet apprenticeship requirements, you're at a 30% credit rate. If you are building a project in an energy community, you get an additional up to 10%. Not a lot of places in New York State are in energy communities, so I'll belabor that. And then if a certain percentage of the materials used in the project are US manufactured products, there's an additional up to 10% bonus. And then there's the environmental justice bonus. And what that basically says is you can apply for an additional credit from the Department of Energy if you have a wind or solar project that's less than 5 megawatts and meets certain requirements. And so I think for the investment tax credit, as Ying mentioned, what kinds of projects are going to qualify here? We're talking about solar, talking about batteries, that could be storing solar or grid power, and we're talking about geothermal properties. These are properties in which you're doing a geothermal bore field to heat and cool a structure. So that I think those are the big three in the investment tax credit area. Again, anything that you're placing in service between January 1 of 2023 and I'm going to say 2035 is eligible, and then you claim the credit, the refund in the year that you finish. Okay, you don't get anything for progress expenditures. You only get it at the end. So if you are looking to build these projects and you're looking for funding, recognize that you would have to have some sort of bridge financing to cover the construction period, because this is only paid at the back end. Okay, let's go to the next slide. So here's a list of the things that are eligible for the investment tax credit. I mentioned solar, I mentioned geothermal heat pumps, energy storage technology as batteries. Thermal energy storage property is property that's used to heat and cool a structure using basically like an ice tank, where you're cooling water when electricity prices are low, and then using fans and blowers to cool a structure when electricity prices are high. Combined heat and power system property, cogen, we do see that in some areas. So this is using a single fuel source, natural gas, and you using it both to heat a structure and also to produce electricity, and that is also eligible under Section 48. Let's go to the next slide. Okay, so these incentives that we're talking about, they phase out for projects that begin construction after the end of 2024. And so you might say, well, that's coming up very quickly, as indeed it is. So for projects that begin construction after 2024, these credits continue for zero emissions facilities and for energy storage technology. So batteries continue to be eligible and solar continues to be eligible. However, things like cogen, fuel cells, and microturbines would likely not be eligible going forward. And so to the extent that you have any of those projects on the drawing board, we're working with clients to make sure that they can get those projects started by the end of the year so that they can be grandfathered into the old rules. You have 4 years from the beginning of construction to finish those projects. So just something to be aware of if you've got any of those projects on your drawing board. Let's go to the next slide. Okay, so as Ying mentioned, to get the 30% credit, you've got to pay prevailing wages and meet apprenticeship requirements. New York State may be fairly familiar with this. I think New York State has similar rules where you're required to pay contractors Davis-Bacon wages. So this may not impact the cost of these projects that much. You may be paying wages at these levels already, but it's very important to understand that because you'd be subject to audit from the IRS, you'll need to have payroll records in hand on a monthly basis to demonstrate that these wages were paid. And then there's also a new apprenticeship requirement. So about 12.5% of all labor hours need to be incurred by qualified apprentices enrolled in qualified apprenticeship programs, and that needs to be documented. Alternatively, you can pay a penalty. If it turned out you tried to find apprentices and you couldn't find them, there's a $50 per labor hour penalty that can be paid to effectively waive that requirement. Also, there's a good faith exception, which says that if you attempted to find a qualified apprentice and met certain requirements and you were denied because the program didn't have electricians, the program didn't have plumbers, then those requirements are waived. This is a big thicket right here. There's a lot of documentation involved, but I know we're at 40 minutes already, so I'm not going to spend a whole lot of time on this. So just be aware, this is extremely important. It's not just that you paid it, you have to document that you did it, and that's the other step in this process. Let's go to the next slide. Domestic content. Okay, so on the plus side, you get up to an additional 10% credit if you used 100% structured steel from domestic sources and at least 40% of the cost of the manufactured products used in the project were domestically sourced. the flip side, there's a flip side here, and that is that for tax exempt organizations, refundability phases out if the domestic content requirements were not satisfied. So if you begin construction on a project after 2025 and the domestic content requirements are not met and the project is over 1 megawatt, then there is no refundability. There is an out. The Treasury shall provide exceptions if there is an insufficient supply or cost would be more than 25% higher if you used items from domestic sources. We are still waiting for guidance on how Treasury is going to implement this rule. I think the takeaway I want to leave you with is that this is why it's important to get started right away. So if you began construction on a project in calendar year 2024, you would get a 90% refund, okay? Even if you didn't meet the domestic content requirements. And it's August 8th. So, time is ticking. On the flip side, if you're saying, okay, well, we've got a project with a longer time horizon, we're going to start in 2025 or 2026 or 2027, it's really important that you get in your RFPs, that whoever's going to respond to your RFP, that they're going to use domestic materials. They need to tell you how they're going to source those domestic materials. They need to tell you how they're going to substantiate to you that they used domestic materials, because that is how you're going to substantiate your refund for tax purposes. Let's go to the next slide. Okay, so I touched on energy communities. So energy communities get an additional ITC, and those are areas on or next to a closed coal mine or coal-fired power plant, and also areas with high fossil fuel employment. There is a DOE, Department of Energy mapping tool, which tells you if you're in a relevant area. There are some places sort of in the western part of New York State that would meet this requirement. By and large, it's a fairly small map, but there is a map. And so if you think you might meet these requirements, it's a quick check to see if you're in there. And then there is an opportunity to apply to the Department of Energy for an additional ITC for wind or solar under 5 megawatts. There is an ordering rule. So there's a certain amount of credits available each year. We're now through the first 2 years of the program, and the program has typically been oversubscribed. So the good news is that tax exempt organizations are prioritized under this program, and also projects that meet certain criteria are prioritized. In particular, projects located on Indian land. There are some Indian tribes in New York State, and also solar projects that are built on low-income housing projects, and also areas where the subscribers to the project, the community solar, is low income. Also, you do get a benefit if you're building your project in a low-income community as defined under the new market tax credit program. So this year's application process is now closed, but this will be every year, and so we're expecting a new application period to open in the fall. You have to apply before you place your project in service or finish it, and you have 4 years to finish it. So you could apply in October, and as long as you finish the project in 2028, you'd be fine, right? So again, something to look at, to the extent that you're looking out 4 years and saying, where might I build solar? Maybe some of these projects I should apply and see if I could get an additional application. Let's go to the next slide. Okay. So a couple things that tax exempt organizations and localities need to keep in mind. Unfortunately, Here's a reduction in the credit if your project is financed with tax-exempt bonds, which may happen. It has to be traceable to the project, not just a general issuance. And the amount of the credit reduction is capped at 15%. So it's not terrible. So if you had 100% tax-exempt bonds, you would reduce your credit by 15%. So it's not a complete loser, it's just a reduction. And then the other thing too is, well, okay, maybe I'm gonna apply to the state for a grant or some sort of forgivable loan. Is that gonna reduce my direct pay amount? Something to keep in mind, but the way the rules are now, and we do have final regs, is that those grants only reduce your direct pay amount if they exceed the subsidy. So, very simple example, if I build something for $100 and I get an $80 grant from the state of New York, and I was otherwise eligible for a 30% credit, then I get a 20% credit, not 30% credit. They're not going to give me the excess. In other words, I can't work out ahead. I can get completely reimbursed, but I can't be reimbursed beyond, what others put in. Let's go to the next slide. Okay, changing gears here. So we're going to talk about two other items. The first is going to be electric vehicles. So this seems to be a fairly popular one for localities. So you may have electric vehicles or fuel cell vehicles in your fleet, or other sorts of mobile machinery like lawn mowers or snow blowers or low-speed vehicles. So under the new rules, under the IRA, if you have a vehicle that either runs exclusively on electricity or is a plug-in, that means it has an ability to be charged by a battery, but also has a gas or diesel combustion engine, these vehicles are eligible for a credit. It's equal to the lesser of 30% of the cost of the vehicle, or 15% in the case of a plug-in, and the incremental cost of the vehicle. Incremental cost is the difference between the cost of a vehicle that runs on electricity and the cost of a comparable vehicle that runs on gas or diesel fuel. Now, if we go to the next slide, it's also capped at $7,500 for smaller vehicles and $40,000 for vehicles over 14,000 pounds. This is going to be your buses, your trucks, your snow removal equipment, etc. And as was mentioned, mobile machinery is also included, like commercial lawnmowers. And there's no prevailing wage or apprenticeship requirements. You do need to, as we talked about at the beginning, you need to register the vehicle and get a registration number. They need title to the vehicle. They need a VIN number. They're going to need a couple of other things to get the registration number, but by and large, pretty straightforward. And the IRS has issued tables that allow you to determine what the incremental cost is. You don't have to come up with that number on your own. There's safe harbors that you can rely on for that purpose. So the next slide.
Yeah, so I guess, Catherine, maybe on the EV, I know, some of the states that we're working with, really place a large volume of, vehicles in service in a given year. So, maybe just like put a dollar sign just to get a sense on the magnitude of benefit we're talking about. So, say like for the smaller cars, right? The like below the weight threshold, the maximum of the credit you can claim per vehicle is $7,500. Just assuming, the incremental cost and all that exceed that. So that's the maximum of the credit you can claim, which is the $7,500. And say, the county, where, right, if you place, say, 200 vehicles in service in 2023, 200 times the $7,500, that's 1.5 million cash refund. Right. You may be able to get back. So, yeah.
Yeah. Well said. And it's not a heavy lift, right? calculating the credit and getting the title and the registration and uploading it into the registration system. It's not a heavy lift. So.
Yeah, so that's where we really see, the largest ROI, if you will, return on your investment. Yeah, you have to provide the information for each of the vehicles you claim, but assuming, the models are going to be very similar or the same, the make is going to be the same. So the information, is not, to Catherine's point, providing the information, completing the pre-filing registration, claiming the credit, relative to the potential benefit you may be getting, it's not a heavy lifting.
Absolutely. So I think this is going to be the last substantive slide. Maybe there'll be 179D. We'll see. I think there is 179D. Anyway, so let's go back. Sorry, go back. So charging stations. So again, this is, you're putting in place electric charging stations, maybe at your administrative buildings or at your schools, or maybe you're charging your buses, school buses, municipal buses. So again, you're going to get a credit for this. The base credit is 6% of the cost. And if you pay prevailing wages and meet apprenticeship requirements, it's 30% of qualifying costs, capped at $100,000 per item. So it's going to be each charging station at each location. Unfortunately, the one downside is it's only in certain geographic areas. So it has to be in a census tract that qualifies as a low-income community on the new market tax credit areas, or a census tract that is not an urban census tract. Again, the good news is the Department of Energy has a mapping tool, so you can just put in your address and we'll tell you if you are in a good area. And there's a surprisingly large footprint here, so don't get discouraged. So it's a census tract is the determination, and they've come out with very favorable guidance on non-urban census tracts. And so what they've said is, a census tract consists of multiple census blocks. So you might have a census block that is in an urban area, like Syracuse, like to pick something. But that census block is also part of a larger census tract that includes agricultural areas. And so generally speaking, if the footprint is mostly agricultural, the whole census tract is non-urban. So you can pull in census blocks that you might otherwise think would be urban, but it's part of a census tract that overall is non-urban, you're good. So definitely worth a look on that one as well. So let's go. I know we've only got 5 minutes, so let's go to the next slide. Okay, so many of you may be aware of this. This has been available to localities for some time. So there's a provision in the code that says that if there's a building and you make improvements to it and you hit certain energy savings benchmarks, the owner of the building gets a deduction capped at square footage for those improvements. And so normally a government-owned building wouldn't care because you're tax exempt, but what the rules allow is for the designer of the energy efficient improvements to be allocated the value of that deduction, with the understanding that the designer would give you a reduction in the contract price for the work that they're doing. So many of you may be aware of this. It's very common to transfer this deduction to the designer. Jails, K through 12 public schools, administrative buildings, warehouses of various kinds. So the thing to be aware of here is that the amount of the deduction has changed and it's better than it was before. So the deduction is now capped at $5 per square foot if you meet certain requirements. And it's also available, there's also a new deduction for qualified retrofits. which is a lower burden. The energy saving targets are lower. So if you've looked at this program before and said, it's not for me, now's the time to look at it again and say, hey, this deduction might be more valuable than what I thought. If you've been using this program, be aware that the benchmarks are lower and the value is higher. And put this in your contracts. If you're retrofitting a building, put in your contracts with the contractor that they agree to share a portion of this benefit with you in terms of contract adjustment. So let's go to the next slide. All right, and that's time.
All right, well, I thank you very much. We do have some questions, so hopefully everybody can stick around for a few more minutes as we go through these questions. One question, I know you covered a lot of dates here and a lot of material. This is a fairly complex regulations in this law. So if a county transportation authority purchased an electric vehicle in 2023, are they still eligible even though we're now in August of 2024? I know you talked a little bit about extensions earlier on. Are we in that period where we can claim or get a rebate or refund on an electric vehicle that was purchased in 2023?
Yeah, I can take that one. Catherine, feel free to chime in. So, we mentioned earlier, right? Most likely our governmental entities do not already have a taxable year already established, meaning that our taxable year is open, right? So say if our taxable year is from 1/1/2023 to 12/31/2023, right? Just assuming that is our taxable year, then we have to file the return with the credit claimed on the return, like making the election, remember, on the return by 11/15 of this year of 24. However, that does not have to be our taxable year, okay? So based on when we place the property, when we place the vehicles in service, based on that date, we can push back the beginning of our taxable year. And as a result, our filing deadline can be pushed off as well accordingly.
Okay, great, thank you. For a solar project, the date used would be when the project goes live. Is that correct?
Correct. Place in service. Yep.
So there's different incentives or different eligible projects depending on year. After 2024, what projects will be eligible, or are for any projects but energy storage? What exact projects would be eligible after 2024?
So in short, the facilities generate zero emission. So some specific examples would be solar. Bless you, Catherine. Solar, geothermal will continue to be eligible. Those are the the technologies. Those is the are the benefits under Section 48. The vehicles like credits for EV charging station that continue to be available. So it's separate from the Section 48 we talked about. That's going to transition into a technology neutral type of incentive.
Great, thank you. We have one question on the 7,500 taken off of EV vehicles. Sometimes the seller takes that credit. Is that how does that work?
Yeah, that's a good question. You want to take it, or I can, whatever you prefer.
Please,
so that's a great question. So before the IRA was passed, there was a rule that said that I'm a dealership, I don't know, ABC dealership, and I sell to a locality, and the rule said that I, as the dealership, could take the credit as long as I disclosed to the locality that I was going to take the credit, and there was an understanding, not a law, understand that probably the locality was going to get a break on the vehicle. They're going to get a discount because I, as the dealer, was going to take the credit. So that provision still exists in the law. It did not go away. So if a locality would prefer to do that and get an adjustment on their purchase price, that is something that they could consider. And you might say, okay, well, why wouldn't I do that? Like, what would be the reason? And so remember, the dealership has to have tax liability to claim the credit. So at least in 2024, they do. And so the dealer might be like, well, I don't know what to tell you. Like, I've got more credits than I know what to do with, and I can't use the credit, in which case maybe the locality would want to take it. Now, starting in 2025, there's a new provision that says that the dealer can take the credit and it's refundable to them. So wouldn't matter if the dealership has enough tax liability, they could claim the credit. So it's something to consider. However, those rules are under 30 Cap D of the code. And so in order for those rules to work, you know, there are some hurdles. That the vehicle has to be assembled in North America. It has to have critical minerals from an FTA jurisdiction, and has to have battery components manufactured in North America. Whereas if you yourself take the refund, none of those rules apply. It's just, it's a gimme. There are no hurdles like the dealer would have.
Okay, one last question. Can you explain again what an energy community is?
Sure, yeah. So the idea of an energy community is to boost economic development of areas that are being hurt by the energy transition. That is, say, workers and fossil fuel industries. So what the law says is that if you build a project in a census tract where a coal mine has closed or a coal-fired power plant has closed, you'll get an extra credit. And then in addition, and this is the bigger one, if you're located in a statistical area as defined by the census that has high fossil fuel employment based on the latest census, which is going to be 2020, then you also get an additional credit. And it's just simply a footprint. That's all it is. And again, it's intended to help these communities that are suffering from the fact that we are going to be moving away from traditional fossil fuels.
Great, thank you very much. That's all I have for questions. I'm sure if anybody has a question after this, they can send us an email, send me an email. We will forward it off to our team at KPMG. I want to thank Ying Ying and Catherine very much for lending, and the team, the whole team at KPMG, for bringing your expertise to this webinar today and to our members. Second, I want to thank our attendees and your patience at the beginning of this webinar for our technical difficulties and for asking some really great questions. This session has been recorded and will be made available on the NYSEC website by tomorrow morning. If you found this of value, please consider sharing this recording with your colleagues. This will end our program today. Have a wonderful day.